Hello and welcome everyone to Almus Market Mornings, your daily dose of global financial updates. Now it's a rainy day in Mumbai, and a similar mood has been brewing in the markets. U.S. Treasury Secretary Janet Yellen made a statement saying that unacceptably high prices are likely to stick with consumers through 2022. She also mentioned that a recession is not at all inevitable. Now, the feared R word has been circulating around the markets for some time now. And to understand more on this, I have our market expert, JK, who will take us through the latest developments. Over to you, JK.
Good morning. So let me start by saying that this week is probably going to be much quieter week compared to last week. We had too many events last week, particularly from the central banks, and too many speeches from the central bankers as well. So we, in fact, today being a US holiday, it's definitely going to be a slow start. Yeah, but on Friday we saw US and European equities stabilizing a bit, but still for the week they ended quite sharply lower, and they were not helped by Chairman Powell's words that the Fed has unconditional commitment to restoring price stability. See, whatever the buying on Friday is part of the short covering rally, because the market has been now selling on all upticks. We have two major indices, S&P 500 and Nasdaq, clearly in a bear territory, and investors are looking to lighten up their positions whenever there is a rally. We need either inflation to come down or the economy to slow down substantially for yields to come down and then help the stock market. And neither of them are going to happen immediately. In fact, this is notwithstanding the fact that many analysts at major investment bankers are saying that there is a 40% chance of a recession in the United States next year as the Federal Reserve continues to raise rates. And of course, our worst fears around Fed have been confirmed that they were initially well behind the curve, and they're playing the dangerous game of a catch up. So this will lead to sharp slowdown in GDP growth, but till there is strong evidence of that, we will have the until we have a strong evidence of it, we will have the Fed going ahead with its rate hikes. On Friday, of course, we had certain important moves. Oil price dumped about 6% to a 4-week low on worries that interest rate hikes by central bank could slow the global economy. Brent prices are just about holding on the key support, but there is a chance that we will have another 5% move on the lower side. In addition to decline in demand amid growth concerns, they were also negatively impacted by comments from Russian Deputy Energy Minister, noting that he expects Russian oil exports to increase in 2022 despite Western sanctions and European embargo. Now, we also had an industrial production data from US, which which was lower following declines in retail sales, Michigan consumer sentiment, etc. Now, interestingly, the US government has been taking several measures to address inflation, apart from the monetary measures which is being taken by the Fed. Now, Fed chairman said, my colleagues and I are acutely focused on returning inflation to 2%. At the same time, the government has been making some non-monetary measures. Like Biden signed a legislation on Thursday aiming at cutting overseas shipping prices, with the law aiming to stop shipping companies taking advantage of the American families, farmers, and the businesses. So besides, the shipping measures also seeks to alleviate the supply chain bottlenecks at the sea that were exacerbated by a spike in demand during the pandemic. Now, another measure that they're examining is removal of some of the tariffs on China, and which will in turn reduce the import prices for the American consumers. So Yellen, in fact, said some tariffs on China inherited from the administration of former president served no strategic purpose. So even if they want to keep China at bay, some of these tariffs have no meaning. That is what she's saying, and considering removing them. And lastly, there is another measure that is contemplated on evaluating a pause in federal gas tax to bring down the prices. So the point that it is being indirectly observed is that the monetary measures aggressively taken will slow down the economy and push it into a recession, which both the politicians as well as the central bank would like to avoid. Therefore, they are contemplating these additional measures, non-monetary measures, which will probably help them to, contain inflation and may not necessitate rate hike in aggressive measures. Let's see whether these things work and as and when they are implemented. Now, on the currency side, dollar after a sharp one-day correction is trying to recover poise again. Yen fell as much as 1.9%, and the bond yields in Japan also fell after their decision to hold the policy rates, disappointing some market players who speculated that BOJ could give into the market, particularly after a surprise hike by the Swiss National Bank. So yen reached the pre-BOJ level of 135.40 again today. Once again, seeing some resistance, and also market is closely observing the comments from Japanese officials whether it converts itself into an action of intervention. If we don't see any intervention happening in the next week or so, I feel the market may try to break the 135.50 resistance and move towards 137. On the European side, there has been some mixed news. Macron, the French president, got most of the seats in the final round of the parliamentary elections on Sunday, but lost its parliamentary majority. And they are projected to win about 200 to 250 seats, as against the 289 required to post straight majority in the National Assembly. So that Macron, the president of France, is a key member of the European Union who has a huge influence over their macro policy decisions. European bond yields have fallen by 5 bps to 1.66. That is a 10-year yield. Italian 10-year yield has fallen much more, which means that the spread between the peripheral country and the major countries have tightened, which has removed some of the concerns for the European people. So euro is still in an undecided state. It's a recovery from 1.037080 post Fed has been halted at 1.0540. It needs to break that 540, 550 levels and through 1.06 to give some sense of stability. Otherwise, it is going to consolidate in the lower ranges, awaiting next big trigger. Finally, the commodity currencies have been facing real tough time because there is a fear of slowdown across the economy. So there will be some hit to the demand, and also China slowdown. All these things are leading Australian dollar, Canadian dollar to trade at a weaker level. Finally, we have the yellow metal, which, in spite of having too many reasons to go up, is still not able to break the resistance at 1870, 1880. And good thing is it's not breaking 1800 as well. So we might be slipping into a slightly higher range compared to the last 2 months. At the first sign of weakening inflation on a sustainable basis, or on central bank, looking to reduce the pace of their rate hikes or yields falling, that is when we expect the gold to pick up momentum on the upside. So till then, we await any triggers for a move. So have a good day. And today being US holiday, there will be no cash transactions, particularly for outward, and plan your transactions accordingly. Thank you.
Okay, thank you, JK. That was insightful as usual. The feared R word has been making the rounds of the market, of course, backed by the slowing industrial production data, which we saw from the US. Oil prices have started catching up with this recessionary outlook, which is a bit on the positive side for India, which is a large oil importer. Uncertain times lie ahead. As we keep saying, manage your risk well. That's it for today. We'll see you all tomorrow.